Okay, thanks for remaining until the end of the conference. We'll have now the last session of this two-day conference, and I'm very happy to introduce first the chair of this session. That will be the Vice President of the European Central Bank, Mr. Luis de Guindos. Good afternoon, Mr. Vice President, and he will introduce the keynote speaker, Professor Diamond. But I'll give the floor to you for Mr. de Guindos, please.
Well, thank you very much, Carlos, and good afternoon to everyone. It's a great pleasure to open the keynote speech session today and welcome Professor Diamond from the MIT, Nobel Prize winner in 2010, for his contribution on the analysis of markets with surge frictions, in particular, the labor market. As we know at the present juncture, the need to better understand the labor market and its development since the pandemic is particularly pressing. In fact, the relative strength of employment growth in relation to GDP has been a feature of the labor market since 2020. From the post-pandemic period to date, the euro area labor market remained strong and resilient despite the current loss in momentum and the weaker economic activity. To some extent, economic activity and the labor market could almost be perceived as being a disconnect when confronted with historical regularities. In these unprecedented times, including the fight against inflation, policymakers feel a great pressure to better understand labor market dynamics. Model-based estimates need to be complemented by the real-time monitoring of data releases and new indicators to inform decisions. ECB staff has made great efforts in this direction, of which indicators such as the wage tracker and the survey-based labor hoarding indicator are very good examples. By developing wage trackers based on collective wage agreements across the euro area, we now have richer, timelier, and more forward-looking information on wage pressures, which are crucial in determining inflationary pressures in the euro area. We continue to closely monitor this data and cross-check them against other sources, like wage pressures from the job posting website, as they have proven to be useful and early indicators of wage growth coming from the national accounts. They allow us to anticipate and better understand developments in the labor market and cross-check the assumptions underlying our economic projections at an earlier stage. These advances are essential to bring in new perspectives help economists and decision makers to think outside the box and better inform our policy decisions. So without further delay, let me give the floor to Professor Diamond for his 45 minutes keynote speech, followed by 10-15 minutes time for questions that will be managed by the organizing committee. Professor Diamond, the floor is yours.
Thank you. I'm glad to have this opportunity. I regret that the circumstances are such that I chose not to be there and present, but I'm sure you all understand the kinds of things going on. I gather I'm the second Diamond doing a keynote speech. And as Doug said yesterday, we are not related, but that doesn't mean that he is not related to a distinguished economist. Indeed, he has a very distinguished economist in his immediate family. I want to say that I'm going to be talking about the US only. I thought it made sense to restrict my remarks to the economies I have looked at in detail, rather than winging it about European matters. I will begin with an extended discussion of the literature about the beverage curve and the difficulty in drawing inferences from it. And then I will talk about the application of the kinds of things I'm saying to the design of monetary policy. Next slide, please. I'm not having a Okay, so here are two of the early statements about what would happen as the Fed started moving along in addressing the inflation that had clearly broken out. Quite different views, and both indeed citing the beverage curve. So how do we get these two very different pictures? Well, the answer is that they looked at different parts of the history of the beverage curve. And as is common in macro, where we do not have the advantage of controlled experiments, as is the case for much of microeconomics, looking at history and trying to decide what's legitimate to infer from it is a major part of the issues. Next slide, please. Is it up? I'm not seeing it. The next slide coming? Can someone tell me what's going on? Ah, thank you. The beverage curve. It is based on data collected by the BLS. It's a monthly survey, wide survey, and it collects information from firms and it combines that with the usual unemployment information. This data collecting started in 2020. The bottom part is how the beverage curve behaved from the start of the data until we got into the Great Recession. At that point, the beverage curve leaped up and started on this parallel track and went along there in a way that raised issues of why has it shifted. And then came the pandemic with the great leap in unemployment, the unprecedented rise in the beverage curve, leaping up, going at different slopes from previous, both flatter to begin with and then much steeper. And then we see the drop in the vacancy rate that we have been seeing since the Fed got very active. So I want to go back and say something about the reaction to the shift in the beverage curve when it came up at the Great Recession. Next slide, please. Here's a quote from Narayana Kocherlakota, who has had a double existence, a very distinguished economic theorist, and then president of the Federal Reserve Bank of Minneapolis. And the beverage curve has shifted, and what to make of it, he says, it's not something the Fed should be addressing because it's a different kind of problem. And indeed, looking at the beverage curve, it is quite common to take the ratio of vacancies to unemployment as a measure of the tightness of the labor market, and then draw inferences from that tightness to the needs for either stimulus or the counter stimulus, the raising of rates. Next slide, please. I want to make it clear that the vacancy to unemployment rate is, of course, a proxy variable for what's going on in a much more complicated way in the economy. Indeed, going back to Okun, the view of the unemployment rate relative to the relationship between output and potential output is again to be thought of as a proxy variable. One should not expect to find a stable relationship between a single proxy like this and something as complex as the labor market as a whole, and of course the determination of output as a whole. What I want to do is go into some of those details of what drives the hiring rate, what not so much drives layoffs, because that's more standard macro, and what drives the availability of labor. Next slide, please. While the JOLTS data has only been available since 2000, in 2010, an attempt was made to look at historic data on help wanted advertising in newspapers and look at the overlap between that data set and the JOLTS data which had come along, and historically create the best analog to the vacancy rate from the JOLTS data to be used for a more historic purpose. An example of the use of that data is this, which is tracking, first of all, the fact that the beverage curve has shifted around a great deal historically. None of this resembling what has happened in the leap since then, but it indeed shows this is something that has moved around a lot. And if you look in the discussions at the time, the focus here is always a labor market view of what's going on. The actual drawing there, the colors for the different periods, is built around looking at what happened when there was the maximum unemployment rate, and then the arrows starting from before that, and then going to at the minimum utility, and then going to the minimum utility after that. And the purpose of that calculation was to make the point that a straight up movement, as we had with the start of the Great Recession, has happened historically a number of times and does not predict whether the minimum utility as the recovery proceeds will get below the previous minimum utility. So in other words, the ability to drive the unemployment rate, I'm sorry, I was saying utility, I meant the unemployment rate. The U's got me confused. The unemployment rate, would it go below what the minimum had been before the recession started? The answer is it could, it might not. And the question of what was driving it didn't seem connected with the kind of discussion that was going on in the discussion of the shifts and the critical term that appears all the time, the term mismatch. Next slide, please. So what does, in fact, drive the extent of unemployment decline? And the next slide, please. No, you've gone two, because the one entitled Unemployment Rate During Recoveries. There we go. Thank you. This comes from the work of Bob Hall and Mariana Kudliak, getting into the dynamics of the unemployment rate. And the scale, which is important to recognize, is a log scale. And their point is recoveries seem to go fairly smoothly, and if you look at those lines, fairly parallel. So their view is one has to look at the internal dynamics of the recovery phase in order to make sense of it. And what sticks out looking at this is if you have a long recovery, you end up with a lower unemployment rate than the previous recovery. And it's just length of recovery issue for whether you get down, not the other element. I have checked with Bob to ask how the current recovery would fit in this chart, and the answer is very different, much faster decline in unemployment. The historic data is of limited value. Next slide, please. I want to turn now to the Journal of Economic Literature survey on the search and matching approach to the labor market. And it points out there that the persistent adverse shifts in the Beveridge curve relationship don't fit the model except by an exogenous deterioration in the efficiency of the matching technology. And I want to suggest to you that that is a widely held view, and one that I think we need to be questioning in terms of looking for what's going on. Next slide, please. The next quote comes from the Journal of Economic Perspectives, a set of co-authors alphabetically led by Mary Daly, back then a Fed researcher, currently the president of the San Francisco Bank. And the mismatch argument is predicated on imbalances in labor supply and demand, varying across industry sectors, geographic areas, and skill groups. And I want to suggest to you that that doesn't make a whole lot of sense. It's natural in the business cycle, first in the recession and then in the recovery, that the business cycle hits different industries differently. The measure of imbalance you would take by looking across industries will be reflecting the fact and the way that the business cycle has hit different industries. The second thing, geography, obviously in the US, industries are not spread evenly across. So again, you would expect that thing to look like it matters. And skill groups is certainly usually a very slow moving issue. Perhaps the current enormous explosion of the use of computers might make that look a little bit different. And indeed, the people who dig into it do not find this quantitatively to be important enough to be a major factor. Next slide, please. So now I want to go back to that JEL survey, which makes the point that the search and matching literature actually comes in two forms. One form is basically a macroeconomics form. It's something I worked on with Olivier Blanchard. And the second form is referred to as the canonical model, referred to as the DMP model. And indeed, it is the model that is most widely used. The literature, in addition to exploring all sorts of theoretical wrinkles, has been used for large-scale simulations to see what it would take to match aggregate data. Next slide, please. One of the key papers in this was done by Rob Scheimer. Where's the slide, please? Where's the slide, please? The one called The Cyclical Behavior of Equilibrium, Unemployment, and Vacancies. Thank you. Rob used, as he says, the textbook search and matching model, and qualitatively, it seems to fit. Quantitatively, it doesn't. And what's the aspect of the quantitative drive? Well, following a lot of earlier macro, the focus is on productivity shocks as a driving variable. and that seems to me to be badly misguided. Next slide, please. So there are two literatures in, next slide, please, in the search and matching literature. Next slide, please. This one's entitled Stochastic Search and Instantaneous Matching. So the micro literature, the one that Scheimer was working in, started with a horizontal supply of vacancies, which grew out of the sense that posting a vacancy, advertising, doing things like that has a cost basis, and there's no reason for it to be other than perfectly horizontal. In contrast, the macro approach that I worked on with Olivier takes the view that the primary movement in this context is exactly what has triggered the recession. Aggregate demand has collapsed somewhat, and then in the recovery, aggregate demand picks up. And so this will show up in the need for labor, and then the need for labor after layoffs and after normal turnover will lead to change in vacancies, which can be thought of from the labor market perspective as exogenous, coming from an outside aggregate demand where expectations are important for profitability. So labor productivity as a shock variable, as opposed to vacancies and separations, both being driven by aggregate demand and the key role of expectations around aggregate demand. So the micro literature looks at business cycle data, and the macro literature looks separately at recessions and recovery, and I want to argue that's the right way to go. Next slide, please. What I want to do next is go into the labor market dynamics in a bit of detail. The point here is the simplest model has a fixed labor supply. Movements between working and unemployment are the simplest way to do a model. Simple models, sometimes referred to as toy models, is a critical part of getting an understanding and intuition about the working of particular parts of the economic process. We use it in micro, we use it in macro. But then you need to go beyond that to bring in many other factors before trying to move from models to a discussion of policy. So the first thing to realize is the movement between unemployment and employment, which is the UE curve in this figure, is just a fraction of the hiring that goes on month after month. The hires from not in the labor force to employment is larger all the time. And the movement from currently employed to a different employer quickly enough so that unemployment is not a significant part of the story, that itself is often larger than unemployment to employment. So the EE flows are very significant. And another way of looking at this is in the next slide, which divides the shares of hires from these three sources: unemployed, employed elsewhere, not in the labor force, relative to the ratio of vacancies to unemployment. Next slide, please. Thank you. What you can see is if you focus just on the unemployment-employment flow, then that's a fairly tight relationship relative to the proxy variable of the vacancy rate over the unemployment rate. However, if you look at the other sources of hiring, you see they're much more scattered, They move in a different direction, and the patterns have shifted more from time to time. So the proxy of V over U looked at hiring is a weak proxy, a good proxy for the unemployment and employment flows, but not for the rest of hiring. And the heterogeneity in hiring is, of course, something of significance for wage determination, and so significance for a central bank. And next slide, please. So there is a significant literature exploring different data sets. Next slide, please. Significant data sets recognizing a lot of the heterogeneity and developing models with different types of workers. Picking one of them I like a lot, again, Hall and Kudliak. It finds for a large fraction of working people, they're employed for long spells, and by and large, unless in advanced ages, they have short spells of unemployment. There is a fraction who remain out of the labor force throughout their careers, and there are people who move around among the three categories, in and out of the labor force, and in the labor force, in and out, back and forth between employment and unemployment. And what's happening over time is different fractions are playing a different role in hiring. Particularly, the first thing that happens is that the recalls of laid off workers is a major part of hiring, more so than later on, early in a recovery. Then the hiring of the unemployment is a major part of it. And then as the labor market gets stronger, the flows from out of the labor force into both employment and through unemployment into employment, that becomes important. So, and then the EE flows is the last one, because while some of it is simply efficiency enhancing, firms recognizing people elsewhere who will be more productive for them than they are in their other job. And so that's a mutually advantageous connection, a quit leading to a hire. But that happens relatively late. That's accompanied by more wage increases. And so this dynamic process is a critical part of it. And I want to talk about some of the differences among these different types of these three kinds of flows. Next slide, please. Data on this sort of thing is scattered. Some of the things I will show you are from early slides, some of the early surveys, some of them are more recent. So this is something from late 90s, early 2000s, a survey looking at the employed and asking the question, did you search for a job in the period before the survey or not? And asking of the not employed, did you search or not? And of course, labeling them unemployed and not in the labor force. And needless to say, search has a great impact on the probability of finding a job, as shown in the next column of numbers. But because the numbers of employed who are not searching is so much larger than the fraction who are searching, despite the higher probability of landing a job, the hires are primarily from people not searching among the employed rather than the people among the employed who are searching. So what about those out of the labor force? Again, the numbers not in the labor force outnumber the unemployed. So again, primarily the hires are again by people not searching. So that suggests that the standard model is simplified in a way that may have it backwards in the extent of simplification. I'll get back to that in a moment. Next slide, please. Turning to something recent, there's now annual surveys coming out of the New York Fed that this is a summary of, looking at now applications sent for jobs. Obviously, we now have a lot of online websites, which are a terrific source for more information on part of the hiring process. And that's part of the difficulty here. Things happen in a great variety of ways, and the data sets will be better at picking up one piece or some other piece. So there are applications sent in the last 4 weeks by the workers or potential workers being interviewed, and offers they received in the last 4 weeks. And first, you see a large fraction of offers received are by employed people who had not made any applications. And those, it happens also, obviously, for those out of the labor force. They're out of the labor force means no applications, and yet they could be out of the labor force with an application, given the standard definition of unemployment. But again, they make a much larger share of what's going on. Next slide, please. I want to turn to the JOLTS data because that's the data that people mostly refer to, as in those opening 2 studies I talked about. And people have examined the implications of the fact that the JOLTS data is based on a survey once a month and asking questions of the employers. So you could ask the question, did you have a vacancy at the last survey, and have you done a hire in this survey? So that's, did you have a vacancy a month before, when we're looking back at hires during the month. And 41.6% of hires took place at establishments that didn't have a vacancy at the start of that month. So that's an issue about collecting data once a month in a process that very much is a continuous time process. So Davis, Faberman, and Halterwanger built a model of daily hiring and fitted that to monthly data with assumptions of what was going on in the time pattern. And they found that 27.4% of hires would have taken place at establishments that were filled without generating a vacancy that would be in the literature. Next slide, please. And an earlier survey led to the conclusion that there were 20% of new hires involved no formal vacancy or recruiting time by the employer. So this was a chance encounter. Employer meets somebody who turns out wasn't looking for a job, but they start talking, and bing, you get hired. Teenager walks into a supermarket and the asks, "Are you looking to hire?" They weren't, but they say, "Okay, yes, let's give it a try." So there's a lot of hires without vacancies, and the element here is we have a lot of heterogeneity. Another aspect of that heterogeneity that I don't touch on is there are full-time jobs and part-time jobs, and the search for part-time jobs is partially looking from people who just want part-time jobs. They're partially looked at by people who want full-time jobs but can only find a part-time job. That is regularly reported, but it's also searched by people with full-time jobs who want to add a second part-time job. So again, interpreting the data given the heterogeneity is complex. Next slide, please. So now I want to turn to efficiency issues because the central bank is concerned about the efficiency of the economy, the efficiency of the labor market, the cost of the hiring process, the benefits of the hiring process, as well as, of course, being interested in inflation. And so one could ask, what are the costs of the vacancy? Well, there's the literal cost of posting. There's the evaluation cost. And so here what happens is you may have an array of people you can think about trying to hire who maybe applied or maybe you didn't. In the economics department, I spent my career when we were looking to hire some tenured professor from somewhere else. We knew about everybody who might be interested, and we would think through the evaluation process looking at an array. If a firm has posted a vacancy on a website, there will be a number and maybe a large number of applications. And the first task is to narrow that down to a small number. Then comes an expensive interview process. And then comes some kind of evaluation. This whole process can be lengthy and expensive. And then there's the extent of perhaps moving the location for the worker. So the worker is also evaluating, is this job one I really want, given the kind of people I'll be working with, the work I'll be doing in the current setting, the mix of work at home and work there. And so that takes time. And then there's the hiring and training, which may be significant if it's looking to people who haven't had similar jobs just before, or it may be very brief. And then, of course, there's the lost output if a firm is short on labor. And there is the flip, which this one early survey, I've got to think it's still true, but I haven't turned up any data about it, that some people get hired before their replacement is gone because, in fact, the replacement will help them move. The issue of how the ongoing labor contract relates to the flows in and out is something that, by and large, the literature on insurance and risk sharing between employer and employee hasn't come to grips with. So with all of this in mind, next slide, please. I think it makes sense to say a shortcoming of the model is that it may have things backwards. So in the DMP model, the stochastic process is locating a potential match. That the analytics of making use of Poisson processes runs through that part of the process. And that's viewed as endogenous to the vacancy unemployment rate, and necessarily stochastic. In the typical model, once a match has been made, the evaluation of whether it leads to hiring happens instantaneous, and two parts. There's a wage bargain in the bargaining version, there's a wage posting in the other version, and both of those reflect the optimization with the dynamics. If we do this, we'll be locked into some contract of some kind, implicit or explicit, or a mix of both. And secondly, if we don't do this, we will be looking for somebody else. The macro version of it that doesn't exist but should says locating potential matches takes no time. Think of everybody just knowing everybody who's out there. But the evaluation of alternatives is time-consuming, expensive, endogenous, which we can think of as recruitment intensity, both the intensity of search associated with vacancy, which is a standard part of the vocabulary, but also stochastic. You found somebody you think you want to hire, that person thinks they want to take the job, and then comes a lengthy discussion while both sides decide if it makes sense. Something that's, of course, even more complicated with two job families, but complicated whenever there's moving involved. Next slide, please. So I want to now turn finally in my last few minutes to monetary policy. And the point here, which was very much in my mind when the Fed started raising interest rates, is that we have great uncertainty about what's going on in the labor market and great uncertainty about how raising the rates would affect what's going on in the economy. And how should we think about policy when uncertainty about the effects of policy is much larger than usual? The famous paper on this subject is by Brainerd back in 1967. It's a study of what happens. I actually didn't know of the existence of this until it was mentioned to me by both Olivier and Bob Solow. The paper has, in its simplest form, a government that has two policy implements. Think of it as the interest rate and the asset holdings. And the issue of how do you use two of them, even if you have only a single target, is something that really is a matter like portfolio choice of the risks that are different on the two sides and what kind of correlation is there between the risks of using these two different policies. Well, with central banking, interest rate change this month, interest rate change next month, those are two separate policies. And the question of how fast you should move because you're learning things in between and because the timing gives them different impacts on the economy, and the role of course, advance notice. That, it seems to me, is a central part which led me to think the Fed should have been going slower than it did. Going faster than I thought was right has to date had no shocking trigger of the next recession. But with long and variable lags, when we get to the next recession, and I say when because I can't imagine central banking will get so good that we'll never have a recession again. So when we get with a recession, we may or may not be able to trace it back to policies for dealing with current inflation, or it may come from something totally different. Next slide, please. So what I want to do is, in light of the enhancement of the unusual nature of things going on in the labor market and how that matters for how wage determination will go forward under different central bank policies, I think there's an ongoing need for repeated evaluation and a reason in particular to question the 2% inflation target. I want to question that in several ways. One way, in line with this recent piece from Olivier Blanchard, drawing on his earlier piece, he's focused as a macroeconomist in the issue of when we have the next recession. We want the ability for the central bank to move quickly and strongly, and a 2% inflation target may leave the zero lower bound on rates to be more binding than anyone would like. He, with co-authors, had previously gone for 4%. He's now calling for 3. 3 is a move up from 2 because there's more ability to deal with the next recession. But he's also recognized, which he didn't recognize before, the salience issue. To what extent do people pay attention to inflation in their thinking? To what extent do they not? We know money illusion is a widespread phenomenon documented in the behavioral economics and psychology literature. But of course, the nature of money illusion is naturally sensitive to the level of inflation people are experiencing. And so he found a study which asks to what extent do people Google searches about inflation, and the study found not a whole lot of attention is paid for low inflation rates, and then it picks up after 4%. So we took 3 as a cautious balancing of that. But I want to bring in a second element, which is the efficiency in the labor market, which is, of course, an important part of the concern of central banks. The normal discussion of it is form of the unemployment rate, but the efficiency is a much wider element than that. It's commonly recognized the importance of attracting people into the labor force for output, but it's also important to recognize the movement of people to more productive matches from less productive matches, an element that's left out of some of the analysis, and we need to pay attention to all of that. I think what came out of the pandemic with burnout, with different forms of hostility, with the experience of some extent of working from home, is that people are doing a lot of rethinking about the kind of work they want to do. And I think this will have 2 implications. One is I think we will have high vacancies, we'll have high movement. We had an enormous quit rate for a while. It's back to normal, but it may be we are getting more of an aspect of concern about the nature of the matching, and we're getting revisiting on hiring and training issues and how to address that. I think the extent of reliance on previous data has to be recognized by the Fed as less reliable than usual. In addition, we have had in the US a 40-year period where the share of labor income in total income has, with swings, basically trended down. And I think we're seeing, with the spread of unionization, with the expansion of the number of labor strikes, a pushback against that, a pushback which also may show up in the political process with less support for business and more concern about labor, which we're seeing certainly with the Biden administration. And so I think going forward, we may be seeing a restoration of some of the labor income move. And the issue for the Fed is to recognize if this is happening, there will be some extent of wage price linkage coming out of it. And the Fed has to ask the question, is living with a bit more inflation, as long as it doesn't take off into a wage price cycle that explodes, living with higher inflation as part of an adaptation process on labor income and labor employment relations, is that a critical part of the thinking? Should it be a critical part of the thinking? With that, I'm happy to turn now to the question period. Thank you.
Thanks a lot. I'll help dealing with the room and collecting questions now. So I open the floor for questions. Thanks a lot, Professor Diamond, for this illuminating keynote speech. Any questions from the room? Maybe while I wait for a question from the room, maybe can I ask probably how exactly having a higher inflation target would depend from creating policy space and interaction with the labor market institution. That is I understand your main point, right?
I think there are two aspects here. One is what's the relationship between demand and supply in the goods market, in the labor market, and we view those in the course of the business cycle as moving together. Both aspects that matter for price inflation and both items that matter for wage inflation. And wage inflation is an integral part of the determination of price inflation. So there is concern about these relative to the most important job for the central bank is not getting an explosion of inflation, because we know that's very destructive of workings of the economy. But if what we have is moderate amounts of inflation, it's not clear there is as long as we don't get an explosion, any real cost in a slightly different rate. And if there were the cost we were measuring, and a lot of this, of course, goes back to sticky prices and sticky wages, that as was presented at Jackson Hole, when you get something as we did in the pandemic of a large shift in demand between goods and services and very different status of those two labor markets, that inflation, given sticky wages, is a help in dealing with labor allocation. And so at different stages in the cycle, there may be different ways of evaluating the value of inflation and the value of wage inflation in getting the allocation of labor better, both through a reduction in unemployment and through just more efficient production. So if some notion of an idealized inflation in different stages of a recovery is telling us that there isn't a single rate that in the course of a recovery is what you would like, then it stops to making sense to say we should have a target rate. And so where I disagree with Olivier is I think it's more appropriate to view a range as saying, in this range, we have no reason to favor one piece over the other as a general proposition. It may be true at some point in time. So in terms of the kind of guidance of what the Fed is trying to do, I should say there's a range of, say, 2.5 to 3.5, that to put Olivier's 3 right in the middle, over which there is no particular basis ex ante for concern. But the job of the Fed is to get inflation down into that range eventually, and eventually is, of course, exactly the way President Williams has been talking about it. He's not saying the Fed is trying for 2% next year, because they're not even projecting that will happen. If they're not projecting it will happen, it's not the target for next year. And I think the idea of both the range as the eventual target and the idea that we will take time to get there should be the basic principles for the Fed.
Okay, thanks a lot. Maybe I'll give the floor to Wolfgang Lemke.
Yeah, thanks, Professor Diamond. Wolfgang Lemke from the ECB. I'm not at all a labor market expert, but was very, very interesting, and thanks for your talk. Just one question, you alluded to it already. So after the pandemic, we have seen different modes of working. So teleworking has increased, remote working. What's your view on how does that affect the efficiency of the search and matching process? And also, is it different across sectors? And if you may, what's the implication for policy? Thank you.
Okay. I think we need to really separate out two phases. I believe a significant shift in the extent of working from home is going to be lasting. I think the process of adapting to that is itself difficult, and will take time. And we're only partway there. We are already reading about disagreements between employers and workers, which in part is contributing to worker mobility, over how to organize an office where you decide you want 3 days a week from each worker in, and 2 days a week they're working from home. The workers, particularly in an urban setting, the gains on commuting may make that look very attractive to the workers. And conversely, they may be more productive because there isn't the same level of fatigue at work. How efficient people are working from home. I think there was a spell when it was new and people were pursuing it more aggressively, and may still be the case. So then the question is which the face-to-face interactions are important for the evolution of the interactions of workers and decision-making of the firm. When are different people interacting with other different people? How do you organize who is in which days? How do you organize the home office to deal with a rather different setup? Do you end up paying less rent? I think this is a process that we're only seeing part way, and I think we will see excess unusually high, let me not call it excess, but as freight I don't intend, unusually high vacancies and responses to it that will hold down unemployment because there are jobs there, but the jobs are there in part because there's reorganization going on, not just across industries or sectors, but within a firm. Because if it's organizing differently, there may be different people who will fit in that sort of arrangement. So I think one of the messages is, particularly in the adjustment process, higher vacancies are less likely to be a signal of a tight market. What will this do to wage bargains? Well, people who like more work at home have indicated in surveys they're willing to take a cut in pay to get more work at home as long as it's small enough. And that again reflects commuter time and cost. So I think it's a two-sided element. Part of it may limit wage increases, but on the other side, to the extent we're moving people from jobs to other jobs, there's a natural tendency for that to be a vehicle, particularly if the original employer is responding, that will be driving up wages in one place or the other. So I think to adapt to that will be to tolerate some higher wage growth. I expect the second factor to be bigger than the first, but I have no basis for that except, I wonder if. And secondly, then we know wage determination and efficiency both feed into prices. So there will be some feedback on inflation as well. And I go back to the Brainerd view. The Fed is in a place where it needs to be less reliant on looking at historic data as a basis for projecting what kind of feedbacks there are from its policy tools into the inflation process over time. And so caution is the extent of my message, not very instructive, but that's what I come away with.
Okay, thanks. Last question to Roberto.
Thank you for your talk. And one question I have is, what is your view regarding the role of inflation expectations and what kind of inflation expectation formation process you think currently we also as economists, modelers, we should think about?
That's a wonderful question, and the timing is terrific. Yesterday, Yvonne Verning, my colleague at MIT, gave a faculty seminar for the faculty on the work he's been doing on exactly these questions, summarizing his work and what's going on in the literature. So I'm drawing on not stuff I have read in any depth, but what I think I learned sitting in on a seminar. And the point is, to a large extent, what Yvonne sees in what's going on is a lot of what's happening now in rising real wages is catch up to past prices. It's not particularly driven by inflation expectations. Inflation expectations obviously matter, particularly on the price setting, likely to be more significant in the decision process on from firms and pricing, output pricing. Then on the wage side, where workers, first of all, they're not particularly concerned with their own firm's pricing, but rather with the prices of the things they buy and the standard of living they've been having, the extent to which they're adjusting to both the relative price changes. Obviously, each individual is subject to a different inflation rate, given the kind of purchasing that they actually do, the consumption choices, the locations they use for purchasing. So the first message here is inflation will drive some wage pressure, realized inflation, and given the sluggishness in wages relative to the speed of prices, and given in particular the fact that price rises tend to be like rockets and decline very slowly. That's something we've seen documented in a number of settings. Catch up and looking at realized inflation is a piece of it. And expectations, I think, are more important for price setting than it is for wage determination, unless we get into something like the historic pattern of building adaptation into contracts. Then the way they're built in the contract is in part, obviously, the contract will relate to realized prices, but the way the contract is organized will be affected by expected prices, including in the US experience, these kinds of contracts disappearing, as happened after inflation slowed down. So expectations matter, but I think they're only a piece of the story, and making expectations the central element in worrying about inflation seems to me mistaken. This is a literature that is very much early in the development process, and there are things we can learn about it. All I would say is the two obvious and boring points. Expectations matter, and it's not only expectations that matter.
Okay, thanks a lot. I give back the floor to the Vice President.
Well, thank you very much, Professor Diamond, for your presentation and for your responses. Perhaps, I will take advantage to ask, a final question to you. What about immigration flows? What's the role of immigration flows in these potential imbalances? So, with that, I think that we can bring, your presence here to an end. But I am interested, because immigration flows are quite relevant in the US and in Europe. So, what's your perception of immigration flows in the functioning of the labor market?
I think immigration is obviously in the US a major political issue, and obviously as well in parts of Europe with Ukrainian immigration and African immigration. And I think from climate change, we are going to see an explosion of attempted immigration, far more, I fear, than we've been observing so far. Controlled immigration in the US setting is how the country was built, how the economy was built. And on an ongoing basis, it's a critical part of the future, getting sufficient immigration and getting sufficiently skilled immigration. Obviously, the US attracts a great number of people from around the world for the quality of education we offer. And a lot of those people stay on, and that's a big boost to the economy. It's getting attention, particularly around startups and IT, where people are saying how many of these startups are in fact immigrants, people perhaps who were recruited here, or perhaps people who came here for education and stayed on. The flip is the internet is making it possible around computer work to be hiring people in other countries. This is work from home at a real distance. And I think we're seeing significantly more of that as IT firms are popping up very visibly in India, in Colombia, in other places. So I think from the point of view of the US economy, we need immigration. We need to attempt to control it. We need to have a process moving immigrants into the opportunity to work in a rapid way, which is currently a disaster in the US, badly run, badly organized. Politics, democratic politics, are inherently slow moving. And that's part of the core checks and balances sense of trying to keep a government functioning in a way that by and large the public approves of. So what bothers me in the US setting is that we're not making use of the immigration possibilities, as well as not attempting to deal with the immigration that's driven by hardship and necessity. Obviously, ending the Ukraine war would have a major impact on immigration and continued, not just continued immigration, but continued staying of Ukrainians who have moved around. straightening out African economies would do a big deal there. Straightening out Latin American economies would do a big deal in the US. So I think what matters for immigration is twofold. One is making sure the immigrants you end up with are dealt with well in terms of integration into the labor market. But secondly, addressing the causes of the immigration that is push, not pull. And this is enormous. It's one of the dimensions of climate change that makes climate change and the failure of governments around the world to do enough to address it. One of the things that gives me nightmares.
Well, thank you very much, Professor Diamond. Thank you very much for your insights, your responses. We have exceeded a little bit our timeline, but I think that this has been worthwhile. Thank you very much.
Thank you for having me.
Thank you. Thank you. Okay, so this officially closed the event. Probably let me ask my dear colleagues and coordinator or organizing committee to join me on the stage. Roberto, Wolfgang, and Catherine, just to say thank you to all of you who have participated to this event. There was a lot of work behind the scene. Let me thank for sure Anastasia Shnitova, Teresa Altersberger, and Caterina Guerrera. Nasser, very instrumental for the success of the event, but also Stefan said, so all our colleagues from DG Communication, thanks for the support. And again, thank you all for being here, for having stayed here until late. And thanks also for the colleagues that have traveled the ocean to came all the way here and to present a paper. I guess also this year, I'm sure we have learned a lot during the 2 days. We hope, I guess, that this mutual exchange of views has been beneficial to all of us to improve our understanding on monetary policy and bridging the science and practice also this year. And we hope to see you even more next year. Thank you.